Chapter 11 talking about equity issue. Okay, we briefly discussed that in another course. Here is this account. Chapter 11. Assuming ABC company at any moment issue stock to shareholder. Issue stock to shareholder. Receive 100,000 cash. Receive 100,000 cash. Okay, remember, okay, chapter 10, we talk about lender. So when your company receive 100,000 cash, but it's the borrowed money that go to liability. For chapter 11, we are talking about the equity. Very similar, but different accounting. Okay? So that is another area we will not talk about in this course. That is belong to your finance course. Your company need to make a decision. When your company would like to raise 100,000 cash, and your board of your board meeting need to make a decision. You want to raise this 100,000 from shareholder or from lender, borrow it. Okay. So chapter 10, we talk about you borrow the money. Chapter 11, we talk about the company issue stocks. Okay. Issue is not borrow. Okay. All right. So difference is chapter 10, we talk about liability account. The cash still the same. Here. Receive this much cash under assets. This same. However, chapter 10, we match liability account. Chapter 11, we match the equity account. That's the major difference. And for next semester, okay, very soon, only 2 weeks away, okay, not too far away. When I say next semester, it sounds very far away, only 2 weeks away, okay. We will talk about what is different, legally speaking, what's different between borrow and shareholder. That is business law. Anybody know what's the difference? So, what's the difference between the lender and the shareholder? Legally speaking.
We do not need to pay check.
Yes. Yes, that's a major difference. Legally speaking, your company doesn't matter lose money or make profit. Doesn't matter. By the end of the year, doesn't matter if your company is getting profit or lose money. You need to pay your lender no matter what. Otherwise, you file bankruptcy. Otherwise, you get sued. Okay, but you don't have any obligation to pay back your shareholder. That is major. Of course, this is another minor thing we'll talk about next semester. But here is the major difference. Okay, in terms of payoff, payback, lender is in the very high priority. Lender does not depend on your company making money or losing money. Lender just sitting there and wait for the interest. Doesn't matter. Of course, if you got trouble, the bank come in to file the lawsuit. But as a shareholder, you can file the lawsuit to your company and say, how come you did not pay me the dividends for 5 years? Right? The shareholder not even can file lawsuit to say get the money back, unless there's fraud, okay? Because next semester, we'll talk about securities law, federal level and state level. The law prohibit any company to raise money from shareholder. It's very strict law. Your company cannot easily raise money from shareholder unless you are qualified under certain rule. Because the reason is very easy to understand. Company does not have any obligation to buy back the share from shareholder unless your company fraud or violate securities law. That's another area too big we cannot talk about right now. But just give you one hint. We'll talk about that issue later on. So here is the fundamental issue, okay? The major difference between lender and shareholder is lender according to your agreement. Okay, your agreement. Borrowed money is called a note. Okay, promissory note. Lender sitting there just waiting for interest payment. Alright? But shareholder once paid the money to the corporation, received stock certificate, that's all. That's all. And another issue is if you are the shareholder of the company, how can you make sure you will receive something back? That is another issue. That is called a company organization. How does the company operate? As a shareholder, how can you control the company to enforce your personal interest to the company? How can you do that? We'll talk about that later on. But here, we just basically we know. Okay, the major difference here, Chapter 10, you receive the money but affect liability account. Chapter 11, your company same thing, receive the money cash money, but affect the equity. And everybody still remember there are two major accounts under the equity. Everybody still remember? Hopefully you still remember, right? Two major accounts under. Number one is contribute capital. The money paid from the shareholder to the company. That is called original capital, right? Contribute capital. The other one is retained earning. The profit from here, right? Every year you have this revenue larger than expenses, surplus. That is called the net income or net profit. And that profit every year go to this account. Go to this account. And that account is under the name retained earning. So there are two major. So for chapter 12, I will not spend too much time, without too much time anyway. So when you receive the money from your shareholder, the cash received, that is on the cash account on the left, and also the same amount go to the equity, and you can subdivide it to say under the contribute capital account. So same amount on the left, same amount on the right, contribute capital, so a balance. And for every year, when you close this, right? When you close this, if this amount revenue is bigger than expenses, then you have balance on the left side, right? And just close it out, close this account, and move to the other side, so it become shareholders retained earning. Got it? So every year, because when you have the revenue bigger, say 100 here and 50 there, so 150, so you have the left side 50. In order to close this 50, you need to put down the 50 number on the right bar. Now here. So you close every year the income statement. If opposite, you have a less revenue, you have a more expenses, then you have balance here. In order to close this side, you need to put this side, then you have the retained earning reduced. Same thing. Another event is dividend. In the book we say dividend. And that is another area we'll talk about in the business law. Under what kind of circumstances your company give the dividend. Same thing. When your company give the dividend, right? You have cash. If it's cash, if it is cash dividend, you have cash reduced. So cash reduced is on the right side, right? And then your return earning also reduced. Return earning reduced is on the left side. So you have these two accounts balance. So for the chapter 11, there's usually this cash account match with the equity account. Okay, any questions so far?